Topic examines alpha, beta, and hypothesis testing as essential concepts for evaluating investment performance and risk within traditional and alternative investments. Alpha represents the portion of investment return attributable to manager skill or active decision-making beyond systematic market exposure, while beta measures sensitivity to market or systematic risk factors. The program explains how investors use these concepts to distinguish between returns generated through broad market exposure and those resulting from active management. In addition, the topic introduces hypothesis testing methods used to determine whether observed investment results are statistically meaningful or likely caused by random variation. These concepts form a critical foundation for portfolio evaluation and performance analysis. A major topic is the distinction between alpha drivers and beta drivers within investment strategies. Beta drivers represent systematic sources of return associated with exposure to broad market risks such as equities, interest rates, credit, or commodities. Passive beta strategies seek efficient market exposure and are often viewed as pure plays on market risk factors. Alpha drivers, in contrast, are associated with manager skill, informational advantages, operational expertise, or innovative investment processes capable of generating excess returns independent of market direction. The program explains that successful alternative investment managers often combine both alpha and beta sources of return. Understanding these distinctions helps investors evaluate manager performance, portfolio construction, and diversification benefits more effectively. The program also explores empirical approaches used to estimate alpha from historical performance data. Investment professionals evaluate whether abnormal returns persist over time and whether performance reflects genuine skill or random luck. The topic introduces the concept of abnormal return persistence, which examines whether managers consistently generate excess returns after adjusting for risk exposures. A fair casino game analogy demonstrates the difficulty of distinguishing skill from chance because random outcomes may appear statistically significant over short periods. The program emphasizes that investors must use careful statistical analysis and sufficient data before concluding that a manager possesses sustainable alpha-generating ability. These concepts are especially important when evaluating hedge funds and active alternative investment strategies. Topic further discusses return attribution and the interaction between alpha and beta within investment portfolios. Professionals calculate beta, forecasted alpha, and realized alpha to determine how much portfolio performance resulted from market exposure versus active management decisions. The program identifies several forms of model misspecification that may distort attribution analysis, including omitted systematic risk factors, inaccurate beta estimates, and nonlinear risk-return relationships. It also explains forms of beta non-stationarity such as beta creep, beta expansion, and market timing effects that may cause risk exposures to change over time. Because alpha and beta can become commingled, performance attribution requires careful modeling and interpretation to avoid misleading conclusions regarding manager skill and portfolio risk. Another important focus of the topic is the role of statistical issues and hypothesis testing in evaluating investment performance. The program explains that non-normal return distributions, outliers, survivorship bias, and data mining can distort statistical conclusions regarding alpha and beta estimation. Hypothesis testing helps determine whether observed performance differences are statistically significant rather than random occurrences. Investment professionals use test statistics, significance levels, confidence intervals, and regression analysis to evaluate relationships between returns and risk factors. However, the program emphasizes that spurious correlations and incorrect assumptions may produce misleading results. Understanding these statistical limitations is critical for interpreting investment research accurately and avoiding false conclusions regarding manager performance or market relationships. Finally, topic highlights the broader importance of alpha, beta, and hypothesis testing within modern portfolio management and alternative investments. Institutional investors increasingly seek to separate systematic beta exposure from true alpha generation to improve diversification and cost efficiency. Sophisticated quantitative models, statistical techniques, and performance attribution systems are therefore essential for evaluating investment managers and portfolio strategies accurately. The program reinforces that alpha estimation remains inherently difficult because financial markets are complex, dynamic, and influenced by changing economic conditions and investor behavior. Successful investment analysis requires combining rigorous statistical methods with sound economic reasoning and professional judgment. Mastery of these concepts enables investment professionals to assess risk-adjusted performance more effectively and make informed investment decisions in increasingly competitive global financial markets.